What is up, world? It's your boy Ton, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. You've probably heard people talk about the feds here and there, and you are probably thinking, who the hell are the feds and what do they fucking do? To be honest with you, I have no idea because I am not an expert on this. If you are any bit at all inclined to learn about how the economy works, I highly encourage you to watch a video by Ray Dalio. I think it's titled How the Economy Works, or How the Economic Machine Works. You can pretty much just Google it and it should pop up right then and there. It's a 30-minute video and it gives you the most simple answer of how the economy works. It's absolutely incredible. I'll put it in the show notes for you guys as a reference. But first off, let's define who the feds are. Supposedly, the feds, or the long name for them is the Federal Reserve. They were created sometime in the early 1900s, so about 100 years ago. They are a central bank, and they make sure the U.S. economy doesn't trip on its own shoelaces. Here's a rundown of what they do. They tweak interest rates, and they manage the money supply to keep the economy humming like a well-oiled machine. They're also watching over banks, other banks, and financial institutions just to make sure that everyone's playing nice with each other and not causing any tidal waves. And lastly, they also offer financial services to Uncle Sam. They also offer services to other banks and the other big players in that financial world so that they're able to keep the money flowing smoothly and steadily. In order for them to carry out their monetary policy, they have to pretty much utilize three different levers. So through open market operations, this is like the Fed's shopping spree. They are able to buy or sell government securities to pump up or trim down the money supply. They can also require a reserve minimum for banks. So the reserve requirements are pretty much rules that the Fed sets for other banks. And the requirements pretty much tell the other banks how much cash they have to keep in their vaults or their piggy banks at all times. Thirdly, they have control over the discount rate. So this is the interest rate that banks pay when they borrow directly from the feds. It's like the Fed's price tag on lending. The feds are essentially a financial detective. They're sifting through economic data like Sherlock Holmes at a crime scene. They look at things like inflation rates, GDP or gross domestic product, and a whole buffet of economic indicators. And with all that data, they are going to essentially come together and figure out what levers and tools they need to use in order to keep the economy running smoothly. One of their key tools is the federal funds rate, or FFR. And this is the OG of interest rates, which has a domino effect on pretty much everything from bonds to mortgage rates. So what the hell is FFR, or federal funds rate? The federal funds rate is pretty much the heartbeat of the financial world. It represents the interest rate at which banks trade money overnight. It's set by the Fed through open market operations, kind of like a thermostat for the economy. So when the feds want to rev up growth, they dial down the FFR, and that in turn makes borrowing cheaper because your interest rates are now cheaper. And when they're worried about inflation, they crank it up to cool things down. It's essentially a reciprocal relationship. If you guys remembered, previously we had something called LIBOR, which stands for London Interbank Offered Rate. But it's gone through a name change, and it's now called SOFR, which stands for Secured Overnight Funds Rate, SOFR. And this is just another tool that the feds use to determine rates, and it's based on the actual transactions in the Treasury market. The Federal Bank of New York will publish this data as well as the rate. It pretty much reflects the cost of borrowing cash overnight for banks, and it's also secured by the good old U.S. Treasury securities. The U.S. Treasury securities are short-term interest rates. Here's what they do. Their main course of action is buying and selling government bonds, like we mentioned previously. By doing so, it lets them control the money supply. It lets them control all the dough that's going in and all the dough that's going out of the system. When they want to boost the economy, the feds will buy government bonds from the banks. So now the banks have cash that the feds gave them, and they will use that money to lend it out to the general public or consumer. Alternatively, they can lower the FFR, and that makes money cheaper to borrow. Because if your interest rates are lower, you're more inclined to pay less interest on that money. But if they're trying to play it safe and they want to curb inflation, the feds are going to sell bonds. So when they sell bonds to the banks are going to have to conversely give them money for those bonds. So since now the banks are lower on cash, the whole economy is going to be tight on money. Money is going to be more expensive to borrow. Alternatively, they can increase interest rates, and now everything will be more expensive to borrow. When the Fed wants to pump up the economy, they lower the FFR. And this in turn makes borrowing cheaper for everyone, from banks to businesses. And subsequently, it will encourage spending, and that in turn fuels economic growth. But when inflation's creeping up, they're going to raise that FFR, or short-term interest rate. And that's going to put brakes on borrowing, and it's going to hopefully cool things down. So let's talk about bonds. The government has a finance department, and that finance department is called the Department of Treasury. And the DOT issues bonds, and they're also called treasuries. Now, these are supposedly the safest fucking things in the world. That's because they're backed by the full faith and credit of the United States government. Why? Why are they safe? Because the government is pretty much unlikely to default. I mean, they can print their own money, for God's sake. Like, if you can print your own money, you're not going to default, right? You could also argue that if they could print their own money, why are they borrowing money? And to be honest with you, I have no clue. My guess is that they want to control their balance sheet, but I have no idea. So bonds, back to bonds. You're going to see essentially four types of bonds. The first ones are called T-bills, or treasury bills. And these are essentially for your short-term needs. They have a maturity date of less than a year. Second up, we have treasury notes, or T-notes. And these are generally mid-range, anywhere from 2 to 10 years or so. Next up, we have T-bonds, or treasury bonds. And these are the ones you want to be in for the long haul. They're usually 20 to 30 years of maturity. And lastly, we have TIPS, TIPS, which stands for Treasury Inflation Protected Securities. And these are an option to shield you from inflation. TIPS offer a fixed rate interest, but the principal value adjusts with changes to the Consumer Price Index, or CPI, which measures inflation, which is how it's designed to protect the consumer or investors against inflation. Now, I want to hone in on the 10-year Treasury note, because this is the one that everyone looks at. Think of the 10-year Treasury note as the MVP of the Treasury team. It's the Beyonce of bonds. It commands attention from pretty much everybody, like investors, economists, and even policymakers. Its yield is pretty much the crystal ball that offers a sneak peek into the economy's future. Next up, I want to talk about the prime rate. You've probably heard a lot of people talk about, Wall Street prime, or interest rates plus prime. So we're going to decipher that here. The prime rate is pretty much the cool kid on the interest rate block. It's the VIP section of the lending world, reserved for pretty much the most credit-worthy customers. When the prime rate moves, other short-term rates like credit cards and auto loans will follow suit. And the prime rate is determined by the 10 largest banks in the United States. And that's the rate that they decide to charge their most credit-worthy tenants. If you're less credit-worthy, you're most likely going to be charged the prime rate plus a point or two, or even more, depending on what your creditworthiness is like. I also want to touch on a little bit of the language of lenders. A lot of times they use a lot of jargon and terms that only finance and bank people uses, so it might confuse you. And the first one I can think of is basis points. This is pretty much the currency of the finance world. You probably heard them talk about 10 bips here, 10 bips there, 100 bips here, 50 bips there. And once again, it gets confusing. So the more you understand it and the more you can talk their lingo, the more they'll like you and the more you can be on the same page as them. So it's important to distinguish the prime rate from the FFR, which is the rate at which banks can borrow money from the Federal Reserve. Unlike the FFR, or the federal funds rate, the prime rate is determined by the large banks themselves and not by the Federal Reserve. It's also worth noting that although the prime rate is widely followed by the market, it's not officially regulated by any government agency. Banks are not legally obligated to adhere to it, but some do. Now, once again, when we're talking about bips, it's basis points, or BPS, and they shorten it to bips, right? So 100 bips, or BPS, is 1%. Likewise, 50 bips is 0.5%, or 0.5%. Just want to get that clear so that you can start talking to your financiers. Now, back to the FFR for a bit. You might be wondering why the FFR, why Treasury rates, and why the prime rate matter. Well, that's because different banks are going to follow different benchmarks. Some are going to rely on Treasury notes, some are going to use the prime rates, and others are going to base their rates on the FFR. And this is also dependent upon which type of product that you're looking to acquire from them. In real estate, where properties are often acquired through loans, lenders become your silent partners on the deal. So each bank are going to have their own requirements. So it's important for you to know what benchmark they're using, and you also want to understand their terms and how they determine their interest rates. This makes you a far more savvy investor, and it allows you to be able to negotiate the terms effectively. And that's a wrap. If you've made it this far, that means you've listened to the entire episode, so thank you. I hope you enjoyed it, and if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.